Welcome to The Explainer. Today we're taking a deep dive into a company called Fiserv, a big name in financial tech. We're going to really dig into the numbers and see what story they tell.
All right, so the big question is, how would one of the greatest investors of all time, someone like Warren Buffett, even begin to look at a stock like this? We're going to borrow his playbook, apply his value investing principles, and see what we can uncover.
And to do that, we're not going to overcomplicate things. We've got a simple, three-part checklist to size up Fiserv. You can think of it like a report card for the business, grading it on the stuff that really matters for the long haul.
So this checklist is going to be our roadmap, and we're starting with the most basic, most fundamental question you could possibly ask about any business. Is it actually making money? Is it profitable?
Okay, first test up, profitability. But listen, we're not just looking for a company that made a profit last quarter. We're looking for something deeper, a real, durable competitive advantage. You know, what Warren Buffett famously calls a moat, that thing that protects it from all the competition.
And wow, just take a look at these numbers. The trend is pretty clear, right? Key metrics like return on equity, which is basically how well the company uses shareholder money to make more money, aren't just solid. They are way, way higher than their 5-year average. And it's the same story for profit margins and return on capital. This tells us Fiserv isn't just profitable, it's actually getting more profitable as time goes on.
So all this points to a company with a really strong business model. And that moat we were talking about, it looks like it's getting wider. That's a definite pass on our first test. So let's check that box and move on.
Now here's the thing. You can find the best company in the world, but it's only a great investment if you don't overpay for it. And that brings us to our second and absolutely crucial test, the price. Is this profitable business actually a good deal right now? And when we talk about price, we have to talk about Buffett's #1 rule, margin of safety. What is that? Well, it's basically a financial safety net. You want to buy a business for way less than what you figure it's actually worth. That way, you're protected if you're wrong or if things just go south.
Okay, and this is where things get really, really interesting. Based on one way of valuing a company by looking at its future cash flows, Fiserv's margin of safety is a staggering 65%. Let that sink in. This isn't just saying the stock is a little cheap, it's suggesting it might be on a massive clearance sale.
Which leads to the obvious question, right? If the business is this good, why on earth is it priced so low? What's going on here? Let's dig into a few more valuation numbers to see if we can figure out why there's such a huge discount.
Let's start with a classic, the price to earnings, or PE ratio. It just compares the stock price to its profits. Right now, Fiserv's PE is under 10. Now look at its average over the last 3 years. It's more than double that. So what does that mean in plain English? It means the market is willing to pay way, way less for every dollar Fiserv earns today than it was just a few years ago.
And it's pretty much the same story when we look at the price to sales ratio, which compares the price to the company's total revenue. The current number is less than half of its recent average. You see the pattern here? Another huge flashing sign that says discount.
And just to round it out, let's look at price to free cash flow, a metric a lot of serious investors swear by. And guess what? Same picture. The stock's valued at almost half of where it's been historically. So all signs are pointing to the market having some serious jitters about this company, which is causing this deep, deep discount. So, okay, from a pure price perspective, this is a slam dunk. It's a clear pass on our second test. The numbers are screaming that there's a huge margin of safety here. But hold on. A cheap price alone isn't enough. We have to make sure the company itself isn't a lemon.
All right, time for our final test, the company's overall financial health. I mean, a great business has to be built on a solid foundation, right? So now we're going to look at a real tug-of-war happening inside Fiserv. Its amazing growth on one side and its growing pile of debt on the other.
And this slide, right here, lays out the central drama perfectly. On the one hand, you've got this absolutely spectacular profit growth. I mean, net income growing at almost 30% a year for 5 years? That is just incredible. But on the other hand, you've got the debt load, which is creeping up and up. It's over 36% higher compared to its equity than it was on average for the past 5 years. And that, right there, is the kind of thing that makes investors really, really nervous.
You know, this whole situation just makes me think of that famous Buffett quote. The stock market is a device for transferring money from the impatient to the patient. Because when you have a cheap price mixed with some worries about debt, what do? You get volatility, you get huge swings in the stock price that will seriously test your stomach.
And just look at these yearly returns. Man, has it been a roller coaster. You have these unbelievable years like 2018 where the stock more than doubled. And then you have these brutal years, like a massive 67% drop in 2025. This is definitely not a stock for the faint of heart.
Okay, so what's the verdict? What do we make of all this? Where does this leave us? Let's pull all the pieces of our checklist together and fill out that final report card for Fiserv.
And that final report card is, well, it's definitely a mixed bag. It passed the profitability test with flying colors. I mean, it's a fantastic business that seems to be getting even better, and it absolutely passed the price test. It looks like it's trading for a song. But that health test, that's a big yellow caution flag, all thanks to that rising debt and the wild swings in the stock price.
And so, all of this leaves us with one final, and I think, pretty provocative question. Is this data showing us a rare, deep value opportunity to buy a wonderful company on sale, exactly like Warren Buffett would look for? Or is this a classic value trap, where that super cheap price is actually a giant warning sign of deeper problems that the market has sniffed out correctly? That is the billion-dollar question.